Today, on our journey to pass the Series 6 exam, we are going to cover index funds and exchange-traded funds, also known as ETFs. We will start by comparing passively managed index funds to their actively managed counterparts. An actively managed mutual fund is run by a portfolio manager and a team of analysts whose entire job is to try and beat the market. They perform in-depth research to pick specific stocks and bonds they believe will outperform a benchmark. Like the S&P 500, this hands-on approach means the fund is frequently buying and selling securities, which leads to higher operating costs, such as management fees and research expenses. This higher portfolio turnover can also generate more frequent taxable capital gains for the fund's shareholders. In sharp contrast, a passively managed index fund doesn't try to beat the market. Its goal is simply to match the performance of a specific market index. An S&P 500 index fund, for example, will hold the exact same 500 stocks in the same proportions as the index itself. There is no star portfolio manager making strategic bets. Because the fund is simply mirroring an index, the management is largely automated, which results in significantly lower expense ratios and minimal portfolio turnover. For the exam, you must remember this key distinction. Active management means higher potential for outperformance, but comes with guaranteed higher costs, while passive management offers market returns with much lower expenses. Now, let's focus on exchange-traded funds. Most ETFs are a type of index fund, but they have a unique structure that allows them to trade like a stock. While they are technically registered as open-end investment companies similar to mutual funds, they don't sell their shares directly to retail investors. Instead, large institutional firms called authorized participants deliver a basket of the underlying securities that the ETF tracks to the ETF sponsor. In return, they receive a massive block of ETF shares, known as a creation unit. These authorized participants then sell these individual ETF shares to the public on a stock exchange, like the New York Stock Exchange. This structure creates critical differences that are heavily tested on the Series 6. A traditional mutual fund is priced only once per day after the market closes, at its net asset value, or NAV. Every investor who bought or sold that day gets that same price. ETFs, because they trade on an exchange, can be bought and sold throughout the trading day at fluctuating market prices. They have a bid price and an ask price, and investors pay commissions to trade them. Just like a stock. Perhaps the most important advantage of the ETF structure is tax efficiency. When an investor sells a mutual fund, the fund manager often has to sell securities within the fund to raise cash to pay the redeeming shareholder. This sale can trigger capital gains, which must be distributed to all remaining shareholders, creating a taxable event for them. ETFs largely avoid this issue through a mechanism called in-kind redemption. When an authorized participant redeems ETF shares, they don't receive cash. Instead, they are given the underlying stocks from the ETF's portfolio. This transfer of securities is not a taxable event for the fund. As a result, ETFs distribute far fewer capital gains to shareholders compared to mutual funds, a huge benefit in taxable investment accounts. To remember these concepts for your exam, think of it like this. A mutual fund is like buying directly from the manufacturer. You place an order and get the single price set at the end of the day. An ETF is like shopping at the e-exchange. You can trade anytime the market is open at constantly changing prices. And for taxes, just remember that the ETF's in-kind redemption process is kind to your taxes.